Hi everybody, and welcome back to video number 4 in chapter 18. And when we left off, we were looking at temporary differences resulting in deferred tax liabilities. So those temporary differences result in deferred tax liabilities when taxable income is less than financial income. Revenues or gains are taxable after they are recognized in financial income that will result in taxable amounts in future years. For an example, an asset, say accounts receivable or an investment, may be recognized for revenues or gains that will result in taxable amounts in future years when the asset is recovered. Other examples. Number 1, sales accounted for on the accrual basis for financial reporting purposes and on the installment or cash basis for tax purposes. Number 2, contracts accounted for under the percentage of completion method for financial reporting purposes and a portion of related gross profit deferred for tax purposes. Number 3, investments accounted for under the equity method for financial reporting purposes and under the cost method for tax purposes. And number 4, a gain on involuntary conversion of a non-monetary asset which is recognized for financial reporting purposes but deferred for tax purposes. And then 5, unrealized holding gains for financial reporting purposes, including use of the fair value option but deferred for tax purposes. But also, expenses or losses are deductible before they are recognized in financial income, and that will result in taxable amounts in future years. The cost of an asset may have been deducted for tax purposes faster than it was expensed for financial reporting purposes. Amounts received upon future recovery of the amount of the asset for financial reporting through use or sale will exceed the remaining tax basis of the asset. Other examples include 1, depreciable property, depletable resources, and intangibles. And number 2, deductible pension funding exceeding revenues. And 3, prepaid expenses that are deducted on the tax return in the period paid. Okay, so let's take a look at temporary differences resulting in deferred tax assets. Revenues or gains are taxable before they are recognized in financial income. And in this case, taxable income is greater than financial income. So in this case, that will result in deductible amounts in future years. For example, a liability may be recognized for an advance payment for goods or services to be provided in future years. For tax purposes, the advance payment is included in taxable income upon the receipt of cash. Future sacrifices to provide goods or services or future refunds to those who cancel their orders. Okay, other examples. 1, subscriptions received in advance. 2, advance rental receipts. 3, prepaid contracts and royalties received in advance. Now we also have expenses or losses that are deductible after they are recognized in financial income that will result in deductible amounts in future years. For example, a liability or contra asset may be recognized as taxable expenses or losses when the liability is settled. Other examples: 1, product warranty liabilities. 2, estimated liabilities related to discontinued operations or restructurings. 3, litigation accruals. 4, bad debt expense recognized using the allowance method for financial reporting purposes. Direct write-off method may be used for tax purposes. 5, stock-based compensation expense. And finally, 6, unrealized holding losses for financial reporting purposes, including use of the fair value option, but deferred for tax purposes. All right, temporary differences have originating and reversing elements. Here, an originating temporary difference is the initial difference between book basis and the tax basis of an asset or liability, regardless of whether the tax basis of the asset or liability exceeds or is exceeded by the book basis of the asset or liability. And then here, a reversing difference occurs when eliminating a temporary difference that originated in a prior period and then removing that related tax effect from the deferred tax account. All right, let's take a look at an illustration. Here, we're going to look at originating and reversing differences. The II-Chapt company purchases a new piece of equipment in 2023. For book GAAP purposes, II-Chapt uses the straight line method to depreciate the asset. For tax purposes, II-Chapt uses an accelerated method that is allowed by the IRS. The following table summarizes the amount of depreciation expense recognized in each year. Here we have our tax depreciation, here's our book depreciation, and here's our temporary difference, which offsets in total over the entire 5-year period. Okay? And then we calculate the tax effect based on a 15% tax rate. So as indicated over the 5-year period, total depreciation expense is the same. However, in 2023 and 2024, the expense is greater for tax purposes. But in 2025, 2026, and 2027, the expense is less for tax purposes. So the questions are, what are the journal entries to record income tax expense in Alpha 2023, an originating difference, and Bravo 2027, a reversing difference? Assume taxable income before depreciation expense is $80,000 in each year. Okay, so if I'm going to record the income tax expense in 2023, I'm going to take the income tax expense, $10,350, plus $750. And we get this $11,100 by taking 5,000 times 15%. If I go back, here's the 5,000, 15%, and that's going to give me 750. And then I take my total 80,000, back out 11,000, which is here, right? And multiply that times 15% to get 10,350. And we do a similar entry for 2024. And then to record income tax in 2027, we take our income tax expense, and that's going to be the 11,700 minus 600. And we get those numbers by taking the 80,000 minus 2,000, which is here, and then here, and then here, we take the 4,000 times 15%, which is here. And that gives us 11,100 as our income tax expense. A similar reversing entry with different amounts would be made in 2025 and 2026, which you'll remember were the years in which we had a temporary difference that was negative here. Okay, a little tricky there, but I think you get it. And I think you see the effects of the deferred tax liability here. Pretty easy to understand here. Sharp had tax depreciation in excess of book for 23 and 24, but book depreciation over tax depreciation in 25, 26, and 2027. All right. Permanent differences. Here, some differences between taxable income and pre-tax financial income are permanent, meaning they only affect one but not the other. Permanent differences result from items that either 1. Enter into pre-tax financial income but never into taxable income, or 2. Enter into taxable income but never into pre-tax financial income. So Congress has enacted a variety of tax laws and provisions to attain certain political, economic, and social objectives. They, 1, exclude certain revenues from taxation. 2, they limit the deductibility of certain expenses. And 3, they permit the deduction of certain other expenses in excess of the costs incurred. Let's take a look at an illustration. Here, a corporation has tax-free income, non-deductible expenses, or allowable deductions in excess of cost. It has an effective tax rate that differs from its regular tax rate. Okay, items are recognized for financial reporting purposes, but not for tax purposes. Here we have some examples. 1, interest received on state and municipal obligations, which are not taxable. 2, expenses incurred in obtaining tax-exempt income. 3, proceeds from life insurance carried by the company on key officers or employees. 4, premiums paid for life insurance carried by the company on key officers or employees, where the company is the beneficiary. And 5, fines and expenses resulting from the violation of law. These items are recognized for tax purposes, but not for financial reporting purposes. Some other examples: 1, percentage of depletion on natural resources in excess of their cost. And number 2, the deduction for dividends received from U.S. corporations, generally 70 or 80%. Okay. Examples of temporary and permanent differences then. Here, we're going to assume that biotech company reports pre-tax financial income of $200,000 in each of the years 2023, 2024, and 2025. The company is subject to a 20% tax rate and has the following differences between pre-tax financial income and taxable income. Here, biotech reports gross profit of $18,000 from an installment sale in 2023. It recognizes the entire amount for book purposes in 2023. For tax purposes, it will recognize revenue over an 18-month period at a constant amount of $1,000 per month beginning January 1, 2024. That looks like a good place for us to end this video, and when we return, we'll take a look at a biotech example. Until that time, bye for now.